Happy Friday. Good afternoon from the Shreveport downtown office of Eagle Financial Management Services for the latest edition of the Jack and Bill Show. I think we've got a real treat for you today.
We do. Oh, gosh.
How to invest using the business cycle. But before we get into that, we'll just where are we on the year this year? Market indicators. We started off, futures markets were up today, kind of rebounding for the week. And then we accelerated down as the day progressed. S&P 500, which had been up about 20.8% on a year-to-date basis, and a little bit more than that earlier in the week, declined 7.8% today, somewhere in there, 35 points. So now we are up pretty much dead on 20% for the year, which a normal stock market typically does 10% a year. So this has been especially good given the pandemic and all the trouble that we've seen. Both the Dow was down similarly, NASDAQ down slightly more, 0.87% or basis points. Gold and silver down, gold down 0.4%, silver about 1.4%. Gold busting through 1,800 into the high 17s. We have had nat gas on a tear, trading over $5 this morning. I actually think that's going to continue, Bill, with the demand for electricity and the move to electric vehicles and things like that.
I thought it was because the current administration wanted to make us energy dependent. Anyway.
Energy dependent. It seems that way. That's not a nice thing to say. Yeah, I mean, we were moving towards energy independence, and now it does kind of look like we're going the other way.
We were there last year.
We were. Okay, the bond market, just a few more. The bond market off today. 30-year Treasury bond yield inching back towards 2%. Still, I don't know how, trading at 1.93%. Maybe because of, fears of the direction of the pandemic. 10-year Treasury note yield 1.34, and the 2-year note 0.239. Let's put that into perspective just for a second, Bill. When you look at some of the largest and most widely held bond funds, Dodge & Cox Income Fund year to date through yesterday was up 0.3%. And I think it gave back all of its year to date winnings today. Vanguard Total Bond Fund ETF down 1.9% on the year, and it weakened today. I'm sure it's down over 2% on the year. So for conservative investors out there, if you've been in high quality bonds, you have not made money this year because the Fed has essentially forced us into the only game in town with the stock market up about 20. And it's interesting. I want to throw a little teaser out there for our audience. We have been purchasing a security called a steepener. So if anybody believes that we're going to have inflation, we've been buying. We can do these in corporate notes. We prefer higher quality with amongst these issuers, but we can buy money center bank issued certificates of deposit, FDIC insured. And if the Fed keeps the Fed funds rate at or near zero, and we have inflationary concerns with the 10 and the 30-year bond yields, note and bond yields escalating you'll see these variable rate CDs climb to 8 to 9 to 10%. I've purchased one that can yield as much as 15%. We can buy most of these at deep discounts to where they were issued, and we have an FDIC insured government guarantee. These are some securities that are kind of a niche market, hard to find, and something that that we're just starting to kind of sink our teeth into.
And may or may not be suitable for you.
True, may or may not be suitable. In the event that we're wrong and the yield curve inverts, the coupons on these things could go to zero. But if you buy them for 80 cents on the dollar, you're still going to make more than you would in the treasuries markets.
Yeah. Just ride it to maturity.
To maturity. So what do you have for us today, William?
We are going to talk about sports.
Sports. LSU
No.
LSU football team, the Tigers.
We may do that later. We've been fielding, a lot of questions lately about where we are economically, where the markets are, and against that backdrop, we try to provide some context to this. And I think one of the best ways of providing some context to that type of discussion is by looking at where we are in the business cycle. And the business cycle, that's a term that's used to refer to the pattern of economic expansion and contraction. And a business cycle can range from a matter of months to years. And we typically see patterns with different investments at different stages in the business cycle. Not saying that, it's a perfect thing, and it's not. These patterns that we can identify don't always repeat. And I think the hardest part, you would agree with this, Jack, is identifying where we actually are in the business cycle. But there are 4 distinct phases in the business cycle, and it starts with the early stage. That is the initial stage as you come out of an economic contraction or recession, and that's where you see the strongest growth. Stocks perform the best in the early stage of a business cycle. So we are seeing a sharp recovery. Gross domestic product growth turns from negative to positive. We see significant sales growth out of companies. And as I mentioned, stocks do the best in this phase. Then as we move through this early recovery phase, we get into the mid phase of the business cycle. Economic growth is gaining momentum. We're seeing credit growth. So that's the availability of loans, businesses being able to borrow, individuals, households being able to borrow. Profitability is healthy. And one of the sectors that tends to do very well in this phase is technology. The next phase that we get into is the late phase of the cycle. And that's when we start to see economic growth peaking. So it's activity is peaking and slowing down. We're also seeing rising inflation, which can lead to higher interest rates. And we see a shift away from economically sensitive stock sectors into sectors that are more defensive. The next phase, unfortunately, but it happens, is recession. And so when we have recession, we see contraction in economic growth. Profits are declining. Credit is scarce. Businesses allow their inventories to contract. And it's during this phase that you see the defensive sectors really outperform. So things like consumer staples. Think about things that you buy every day. Toothpaste, toilet paper. Those are examples of consumer staples. Healthcare and utility sectors tend to do well. So those are the phases of the business cycle. And as I mentioned, I think it's a good backdrop or context for answering questions like, well, what's going to happen next? Are stocks expensive? What's happening with the economy? And frankly, it's just hard to really gauge where we are. there has been a lot of discussion about this because the pandemic really upended everything. We had a recession last year. It was very short-lived, but we had a recession.
Yeah, Bill, and I would add to that, just to go back and kind of reiterate that. Bill's talking about the 4 phases of a business cycle. And I'd like to go back and just back up for a second and say, okay, so we have long-term secular trends or patterns. Like, for example, a cycle in interest rates might be 50 or 60 years long.
Oh, yeah.
From say 1975 to the present.
Or look at commodities. That's a long secular cycle.
And then so the business cycle, we were inspired, we'll just say this from an article that came from Fidelity on this, and they talk about the business cycle lasting 1 to 10 years. I mean, I've always heard, just to cut it with a meat axe, call the business cycle typically 5 years. But Bill, Australia was had a period of 25 years without recession. So it doesn't have to be this way. And then we talk about tactical or seasonal. So there's seasonality issues in here. And I've found that at different stages that we've been in, historically, it's profoundly difficult to get or to trade on, whether we're early cycle, mid cycle, late cycle, or recession, or to try to predict when the next one. But it was really very easy to me with the pandemic. I mean, the pandemic hit, essentially we were in a pandemic inspired or induced recession very quickly.
Oh, yeah.
And we came out of it very quickly.
Yeah.
So now the big question is, how far along are we?
That is a very difficult question to answer. And it's one that is hotly debated on Wall Street. I was reading something that was produced by Deutsche Bank and their chief equity strategist, a man named Chadra Binky. Anyway, he did point out, and this is something that we've discussed, and everyone knows this, that equity valuations are very rich. I mean, just about, by just about every measure, we can say that stocks are expensive, with one exception, and that is relative to bonds. So let's just start with that. Equity valuations are rich. Does that mean that we are going to see a big correction in stocks because equity valuations are rich? No, because we know that equity valuations can get richer.
Well, I'd like to throw another wrinkle into this. It's interesting that Fidelity writes that that you're in mid-cycle as profitability is healthy and monetary policy turns increasingly neutral. I mean, there's just talk about that right now.
That's right.
And the profitability is healthy in some areas.
We've had strong earnings growth.
We have, but what is the Fed doing? They still have the pedal to the metal,
that's right,
so to speak. So I would go back and say, if we get outside of the business cycle and talk secular long term, since 2007, 2008, we've had world central banks with the gas pedal all the way down, almost.
It's we've never exited the post credit crisis bubble.
So that's right. So we've had these early cycle, mid cycle, late cycle recession has been tremendously influenced. You could even say business cycles have been prolonged or expanded, accentuated, manipulated by the actions of the world central bank chiefs, Japanese, European, United States. Yeah.
Yeah, I agree. So it does. The central bank activity has basically clouded, what we could normally point to as to where we may be in the cycle. It's very confusing. And I like what you said about, okay, so profitability has been strong, but the Fed has still had the pedal to the metal. Normally, the Fed has the pedal to the metal and they're stimulating in the early phase. And then they start easing off because we see economic activity normalize. But they've never done that. So I don't know. All bets may be out the window.
You know what else is an interesting wrinkle to this whole thought process, I think, Bill, too, is in the current situation, we've got different things going on like that are related to where we stand with the pandemic. Right. Are we reopening or should we be closing? And this is a huge political debate, and it's really divided whether you live in a red state or a blue state. You could be economically proliferating or you could be closed, And so do you want to own tech? Do you want to own tech companies, and do you want to own defensives, or do you want to own airlines and autos, So there's
we've seen that vacillate back and forth between the two over just a matter of months, and it's going back and forth. Okay.
Absolutely.
I mean, during the lockdown, it was technology that outperformed, and it was the economically sensitive sectors that woefully underperformed. And then as we got into the fall, the cyclicals came roaring back. Technology, came out of favor a bit, and that continued through mid-year. And then we saw the cyclicals start to soften a bit. We've seen utilities do well here lately. And all the while, we've seen interest rates go down.
Well, that's why we've seen, Bill, as you point out, utilities are interest rate sensitives. They're large users of capital. They borrow a lot of money. So in Q1, we had an interest rate shock that was alarming, and things settled back down in Q2. And that's why we've had appreciation with electric utilities. I might add something else too, because you just went through early cycle, mid cycle, late cycle. Recession is not imminent, but it's lurking. But we've had seasonal or tactical factors that have influenced the duration of early, mid, late cycle that can be very confusing, that have been driven by where we stand with the waves of the different the Greek alphabet in terms of the pandemic. Alpha, Delta, Gamma. What's next? Hopefully we're near the end of this thing.
I think there's a mu.
Yeah.
But okay, like when we look at it in a short time frame, we've had spectacular GDP growth coming off the pandemic lows. But over a longer time frame, we're still below trend.
Yeah.
And so a lot of
very
people,
below.
Yeah, a lot of people will point to that and say that the better part of the recovery is yet to come because we're still below the long-term GDP growth trend line.
But we've had a crowding out effect along the way too. And let me explain that. When your national debt, when anybody, personal debt, if someone lives their life highly levered, there's not a whole lot of room, for growth. There's a choking out or a crowding out effect when you look at the debt of a nation compared to its gross domestic product. And I would say, for years and years, we grew at 3 or 4% GDP growth net of inflation. Or we call that real growth versus nominal growth. And, we haven't had that for 10 years. I mean, we've got very rapid growth, as you say, right now, because that's been Fed induced, and we've come out of horrific numbers where people were afraid to leave the house, you know. So then we've got this market with very high PE ratios, and the big question to me, Bill, is are the earnings going to catch up to the very high PE ratios? And let me explain that. If the market sells at 30 times trailing earnings, that means for every dollar per share that a company earns, you pay 30 times. Well, historically, that number has been around, closer to half that. So, and then, the thing that's looming ultimately in the business cycle is recession, which a lot of people historically define that as two declining quarters of GDP, so negative growth, or you could say declines 2 quarters in a row. So we're not. That's the thing. I don't know where you were going with your notes, but I'm just curious, Bill. Where do you think we are in this thing right now?
I think it's highly unpredictable because of all of these cross currents. It just makes it very difficult because we're not in a period that we've ever experienced. I mean, going back to the credit crisis of 2008, we never had one of those. We never had, or up until that time, we had never had Fed intervention like what we experienced then in 2008. Now, fast forward to 2020 and the pandemic, the Fed intervention was greater for COVID than it was for the credit crisis. So before, we were in uncharted territory. Now we're way out there in uncharted territory. We're in space, and so it makes it very difficult. But I'm cautiously optimistic, Jack, because I think that there are still very strong forces at play that can continue driving the momentum forward. And this terrible acronym TINA, there is no alternative, is still in play. You cannot make any money in the bond market with traditional fixed income assets. So we're having to be unconventional. And so it is forcing people. It has, and it is, and it will continue to force people into risk assets. As far as the underlying economy goes, we're not fully reopened yet. And there's still a lot of unfilled jobs out there. So we could see, continued economic growth going forward. So I'm just kind of in that, as I said, a cautiously optimistic mode that this can continue. I don't know that it's going to continue at the clip that we've seen. I don't think so. But I would caution people about getting too nervous at this juncture. And we may see, some kind of correction. It could be just a rationalization of pricing where we could see multiple contraction. Earnings could continue to grow, but we could see the multiples that people are willing to pay for stocks contract. That would be healthy.
Yeah. So what you're saying is that stocks could just kind of move sideways.
They could.
Well, we've kind of had that for a month or two, really. Just a sideways movement in the market as the earnings catch up to the valuation metrics. And I'm inclined to say, Bill, and I think this is easy to say, we're not in early cycle.
No.
Because we came just rushing out of the pandemic. And then as we reopened. So we're somewhere between mid-cycle and late cycle. Of course, you never can pinpoint this until after the fact by looking backwards. And that's not a good way or a good strategy to
invest. No.
To invest. So we can't go back and do it again. We've got to be in the best position for our clients, right now. We have to live in today. And so I think we're late mid-cycle to, early to late cycle is just my 64-cent
We're in the thick
prediction.
of it.
Huh?
We're in the thick of it.
We're in the thick of it. That's exactly right.
We're in the game.
What's next?
Wesley, are you out there? He's still with us. Okay, just checking. That's all I wanted to share.
Yeah, that's good. So we've kept this kind of brief, and yeah, and that's the thing. We have made some changes to move from some cyclical names and to be more defensive. And some of the defensive names, and let me see this, so there's no confusion. Defensive doesn't mean defense stocks.
No.
Like Raytheon and Lockheed. That means those are defense stocks. Defensive stocks are when you want to get defensive in the marketplace.
They're economically defensive.
When you want to play defense.
Mm-hmm.
You can own things like consumer staples, healthcare, think pharmaceuticals, higher dividend yielding stocks, companies that always make money, regardless of what stage we are in the business cycle. And then some tech or growthy names would fit in that too, that aren't necessarily defensive, but companies like software companies that just about always have earnings.
They're secular growers.
But so you would want to shift from economically sensitive things like autos, airlines, casinos, things like that, into things like, cereal, foods, healthcare,
toilet paper, toothpaste.
Yeah, exactly.
Things you use every day that you will always buy every day.
Exactly. And we we think with interest rates having moved down in Q2, we're concerned that rates go back up, because in mid to late cycle, you can have inflation. You can have the Fed getting ready to try to dampen things with economic growth. Question is the economic growth really going to continue, and are we going to come out? And with that, we could see interest rates move higher, but you've got to throw in there that, we've got commodity inflation now and things like that. So we think it's a good time we're increasing credit quality in some ways. And anyway, we mentioned the steepeners earlier, but what else?
Well, the administration just said yesterday, I believe, that if you strip out pork, beef, and chicken price inflation, that we don't have grocery store inflation. We don't have food inflation if you strip out those three.
What about Wagyu?
Yeah, I don't think they considered that.
Wagyu is up like 100%.
But I mean, that's just like saying, okay, if you strip out food and energy and housing, we don't have inflation.
Okay,
Well,
housing inflation is huge.
Everyone needs housing and food and energy.
So, I mean, those three things that you typically strip out to arrive at core numbers are absurd. What about healthcare?
Oh, yeah.
I mean, healthcare has been doubling every 3 to 5 years in terms of how expensive it gets. Well, Bill, guess what's happening tomorrow? We have Ogeron versus Ogeron. Did you know that?
I did know that.
LSU Tigers, Westley, are taking on, they're being invaded by McNeese State, a lesser FCS program, and LSU's head coach, who may be on the hot seat, playing an FCS opponent that has his son as the starting quarterback. So and my oldest daughter happens to be she has a PhD in marketing as a college professor at McNeese, who's got a 1-hour drive down the road to Baton Rouge to
Is she
play.
going?
I have no idea. I haven't asked her. But NFL is underway. Our fantasy football started last night. Our opposition had 2 players in the mix, and they didn't do all that well. But there was a terrific start of the NFL season last night. Did you watch it? The Tampa Bay Buccaneers with the GOAT of all goats. You know what a GOAT is, William?
I do.
The greatest of all time. Tom Brady, 42-year-old Tom Brady, taking on Dak Prescott and Jerry Jones's Dallas Cowboys. The game came down to the wire, but I was amazed that Tom Brady threw a number of touchdown passes, and his arm was nothing short of a rifle. So it looked like Dallas was going to pull it out, and Tampa Bay went down all the way down the field with 1:24 to go and kicked a field goal to seal the victory.
Yeah,
So,
I don't know if I can do it, Jack. I mean, watching the NFL, if I want to be lectured, I guess I'd go back to school.
Lectured on what?
Everything.
Well, you know what NFL stands for, don't you?
What?
Not for long. Okay.
All right.
That's true if you miss the most important field goal of the day. So we are wrapping.
We're wrapping up.
It's we're looking forward to cooler temperatures, and stay healthy, make good decisions, and we'll see you next Friday.